Hello, everyone, and a very warm welcome to this University of Liverpool presentation on systemic analysis of stock market prediction techniques. Now, we've all heard of the term stock market before, and a lot of different things comes to mind when we first hear of the term. It might be money, the bull outside New York Stock Exchange, or the infamous movie Wolf of Wall Street. But what the stock market really signifies is a key pivot in every growing and thriving economy and is a very strong reflection of the GDP of any country. And we all know that every investment in the market or in our lives is aimed at maximizing profit and minimizing the associated risk. It is becoming vitally essential to study and learn about the financial market extensively, and hence, numerous studies have already been conducted on the stock market prediction through fundamental analysis using various soft computing techniques and algorithms. Like many before us, our eye has also caught the critical importance of advancements in stock price prediction and the attention it deserves, because not only would it make people's financial investments more secure, but it has the power to bring about global economic parity. The primary intention of this work is to give you a detailed review on various stock market prediction methodologies for predicting future trends in stock returns. And all our research primarily factors in adapted methods, their publication years, performance metrics, datasets employed, and the various software tools deployed for each technique. Later on in our presentation, we will be talking at length about the existing and prevalent methods in stock market prediction, which are majorly categorized into distinct classification and clustering techniques. But before we go any further, let's discuss the factors that find themselves at the very core of this problem. The stock market prediction for analyzing the trends is complicated due to intrinsic noisy environments and large volatile nature associated with the market trends. And when you factor in complexities of stock prices like quarterly earnings, market news, and varying changing behaviors, which can be both political as well as social in nature, it makes the stable and reliable dataset further hard to collect and process. The use of financial time series for forecasting trends becomes an issue due to certain complex features like again volatility, irregularity, noise, changing trends, and that is why we have to strongly depend on the conventional time series such as the fuzzy time series. Even through all this, what gives us hope though is that traditional techniques strongly point that stock market earnings are still heavily dependent on previous stock returns and prior response to predictable situations by a particular stock, which is information that remains constant and is less and has less scope for variability. Now, to just give you an idea of the many intelligent techniques, namely soft computing algorithms, which is neural networks, backpropagation algorithms, and genetic algorithms, are applied for predicting the stock market returns and are utilized to deal with the artificial intelligence for making decisions using the profit and loss criteria. At the same time, there are multiple AI techniques like ANN, which is artificial neural network, and CNN, which is convolutional neural network. These are devised for predicting stock market prices. So now we will discuss what is the need and the description of this idea and what we need to do going further.
As has always been the case throughout history, there is always a rush in the market to maximize profit, and this can be achieved by predicting the market. Stock market and its advanced application, which in turn generates a lot of profit, leads to a need of successful market prediction. This can give a company or an individual an edge in the constant race of investing and trading stocks. As one could imagine, these are the trends that are most important while predicting how a market would perform. There are various algorithms that can help us monitor, predict, and regulate the market. These details come in handy while trying to take a decision regarding how to invest in a market. For example, analysts are not concerned with any of companies' fundamentals. They rather determine the future price of a stock based solely on the trends of the past price. This is called time series analysis and is a perfect example of the sort of algorithm we need. These prediction mechanisms in turn help to bring in different varieties of investors into the market and open the market up for new exposure and subsequent investment. Just predicting by looking at the numbers is a really challenging task and is hardly done among regular traders anymore. The investors now use data mining tools that helps them predict the prices of the stock depending on how the company has performed and how the historic prices have been. These tools can also help the company understand how the market works and helps in making knowledge driven decisions. This intelligent data analysis helps the tools to generate results with ease. The extraction of useful information is an effective way for mining data. Several data mining techniques and knowledge discovery from databases have been employed for analyzing the market trends. Data mining is essential for predicting the stock market. This can search the hidden parts and increase the accuracy levels for analyzing the market trends using techniques. These techniques include the regression approach, knowledge discovery in databases, or the fuzzy models for making effective investment decisions.
Stock market can be accurately predicted by using certain algorithms. In this video, we are only going to see ANN, CNN and K-means algorithm. The first algorithm that we are going to see is inspired by a human brain. It is known as artificial neural network. As in biological neural network, artificial neuron receives certain inputs, does some computations and provides its output to the other neurons. This output then is supplied to the other neurons as an input, thus creating a network of these neurons. This simple neural network is powerful, but it fails to approximate more complex functions as shown in this figure. So these data points cannot be approximated by a simple neural network. To overcome the complexity of analyzing such functions, we use deep learning models. These deep learning models have multiple hidden layer neurons that can be used to predict more or to analyze more complex functions. The prediction of stocks is complicated mainly due to the fact that the stock prices can be influenced by multiple factors. To overcome these factors, we can use deep learning models to approximate the functions and thus accurately predict the stock prices. One of the deep learning model is a convolutional neural network. It uses convolutional layers to memorize or to analyze difficult patterns in a dataset. These patterns are then supplied to a fully connected layers in a neural network which predicts the different classes of the dataset. This algorithm is divided into two parts. First is the convolutional part and second one is the deep learning part. So deep learning is a subset of this algorithm. The last algorithm that we are going to see is a clustering algorithm. This algorithm uses k nearest neighbor as a key feature or a key point to classify the given point in a different class. So these points in the data sets are the key factors that influence a stock price, and by calculating the distance between the nearest points, we can classify a given point into a different class. These distances can be calculated by using the Euclidean geometry. The prediction of stock prices becomes more complicated or challenging because of the unpredictable nature of certain factors. These factors add to the stochastic nature of predicting the stock prices. These factors includes company reputation, country's reputation, industry trends, and so on, like company's history. These data points or these factors influence the data set to becomes more challenging and more unpredictable.
The analysis of the stock market prediction is based on publication years, prediction techniques, clustering techniques, datasets employed, software tools, and accuracy. This part presents the analysis based on the publication years of the considered stock market prediction techniques. In this graph, you can see the number of research papers published in the years from 2010 to 2018. From the 50 papers surveyed, more number of works, that is 11 research papers, were published in the year 2011, and in 2018, 7 research papers were developed for stock market prediction. This analysis is carried on the basis of the employed stock market prediction techniques. The techniques employed for the effective stock market prediction is depicted in this figure. From this figure, it is noted that 29% of the works employed the artificial neural network, 11% of the research papers used SVM, and 23% of the works are based on NN. Thus, NN and ANN are mostly employed techniques for stock market prediction. This analysis is on the basis of different clustering methods employed for the effective stock market prediction. In this chart, we can see that 56% of the research papers are based on fuzzy-based system, 19% of the papers use filtering, 19% of the papers utilized optimization techniques, and 6% of the papers adapted the k-means clustering. Thus, it can be noticed that the fuzzy-based technique was utilized in more research papers for stock market prediction. Here we will describe the analysis based on the basis of the software tools employed in the research papers. The major software tools employed in the research papers are JavaScript, Python, MATLAB, and TensorFlow. Among these four, MATLAB is frequently used software tool for effective stock market prediction. Now we will elaborate the analysis carried out on the basis of datasets adopted in the research works. Various datasets employed for the effective stock market prediction are depicted in this graph. The frequently used datasets for the stock market prediction are BSE, TAIEX, and S&P 500 indexes. Other datasets considered are Nasdaq, Istanbul Stock Exchange, Yahoo Finance, Chinese stock market, and National Bank of Greece.
So, to summarize in this paper, we have made an effort to present a survey of different techniques employed for attaining effective stock market prediction, which are categorized majorly on the basis of prediction and clustering techniques, and the findings for us are very stirring and insightful. Going forward, it's equally important to discuss the research gaps and the issues that this topic faces, because that gives us a scope for future improvements and enhancements. The biggest challenge we face right now is that most of the existing techniques cannot be applied to detection using historical stock data, as they are affected due to certain factors which involve government policy, decisions, market sentiments, and the volatile nature of the stock market, which further makes it difficult to apply the vintage linear models and regression techniques. Secondly, during this time of big data, as more data is becoming available, we face new challenges in processing and visualization of data to extract knowledge and analyze the effect on stock prices. Some of these challenges include live testing of stream data, algorithmic trading, long-term predictions, and sentiment analysis on company filings. But these limitations, like every other limitation in life, can be overcome by selecting suitable prediction techniques for specific domains. And a certain good example of that would be that in the future we can combine one of the two methods together and get better results and outputs. The results from our analysis also highlights that neural network algorithms offer the best ability to predict the stock prices, and which are more accurate than any other existing tool or technique out there. The accuracy of the predicted output values lie within 20% of their corresponding target output value. By using this tool, one can have the ability to forecast the stock prices of stocks much more accurately. This analysis can be used to reduce the error percentage in future stock price prediction, and it increases the chance for investors to predict the prices more accurately by reducing the error percentage, and hence increase their profit in share markets, which benefits both the company and the investor in the long run. Utilizing neural network models together with other forecasting tools and techniques can be considered yet another valuable advancement in the age of technology. So the future for this topic, even though very challenging, has a lot of scope and opportunities to make trading safer, more scientific, which benefits everyone from the traders to the organizations and even to that middle class person who feels the system is rigged against him or her. Lastly, I hope our presentation was able to shed some light on this very intriguing topic and was able to awaken the wolf inside you, both as a future investor and a computer science student.